Hello, students. Well, today we're going to start a series of videos on the cash flow statement. And, this could be a pretty long topic, so I thought we would break it down into some smaller videos. Now, as you know, we prepare our accounting records and financial statements on the accrual basis of accounting. So we can have a sale, a big sale maybe, and no money this year. Maybe we get our money in a month or more, but it could be the next fiscal year. So when we use the accrual basis of accounting, money is not the same as a sale or a payable. Maybe we incur a payable sometime in December with the December 31 year end. We don't pay it until January, so we haven't spent any money. Same thing with a number of expenses. So this means we need another statement because investors want to know if we have enough cash to pay dividends. Creditors want to know if we have enough cash to pay the bills. And as you know, in society, money is really important. So, strangely enough, we have an income statement, but you can't spend net income. You can only spend money. And of course, as you can see here on the screen, there are a few sayings in society that really show us how important money is to everyone. And, you can look those up and fill them in. So in this first video, we're really just going to have an introduction to the cash flow statement. And what we're doing with the cash flow statement is we're showing our financial statement readers where we received money, real cash, throughout the year, and where we spent money throughout the year. Now, obviously, a business gets a lot of money from a lot of sources, and they spend a lot of money on a lot of things. So to make this statement a little more readable, we're going to split it up into some categories. And, I'm sure you've seen this in your introductory accounting course, but we're just going to kind of review it here because it's one of those topics that sometimes people didn't quite get well on their intermediate accounting. So we first talk about cash as either an inflow, we received it and we have more, or an outflow, we paid it and we have less. The statement breaks down into three different categories. Operating activities are basically what we do for a living. We sell things. We sell goods or we sell services. So when you operate, think of the operating section on your income statement. It isn't about buying and selling equipment. It's about what you do for a living. Your sales minus your cost of goods sold, and your selling and administrative expenses, and so on. So this is the first section, and this is an important section in the cash flow statement because it says, hey, are we actually getting a net cash inflow from what we do for a living? I mean, every business should be producing cash from its operations. If you don't, then long term, you're going to go broke. Now, the next section would be investing, and this has to do with anything you invest in, such as long-term assets or, patents and intangible assets. So when you spend your money on something that is not working capital, such as, buying goods, it can cost you a lot of money, and that is a cash outflow. So we're going to keep track of investing activities as a cash outflow for buying any kind of long-term asset, and then an inflow when you sell those assets. So in this section of the cash flow statement, the net is almost always cash outflow because, you're buying assets at full price and when they're new, and of course you sell them when they're old for a lot less money. So overall, you actually have that happening to a cash outflow. this section, investing, remember, also includes investments in fair value OCI securities and held to maturity investments. So, if you invest in the shares of another company, or you invest in a bond of another company, then that's an investing activity. It's not a liability, it's not operating. So you're putting your money into an investment, and then when you sell that investment, you may have more or less than you invested. Now, the last category for financing involves money that we essentially borrow and pay back, and it involves also our shareholders' equity, such as receiving cash from issuing shares and repurchase of shares, which would cost you money, right? So incurring a long-term liability, paying off a long-term liability are examples of financing activities. Now, before we go on, let's just talk briefly about IFRS and two things: interest and dividends. IFRS gives you a choice of where you want to put these. So let's say you have purchased this bond as an investment and you receive interest. Well, the question is, do you want to call that interest revenue, the cash you received, an operating activity, or do you want to put it in with your investing activities? So you have a choice. Interest received and dividends received in the same way can be classed as either part of your normal operation, you put them in operating activities, or investing activities. And your choice would depend on where you just view these in terms of your business. If you think that this is a main area of your business and you think you're going to always have interest income, then you might choose to put interest and dividends received under operating. And if you think it's maybe less important to your company and not something that you're going to do all the time, you may choose to put it in investing. Now, in the same way, interest paid and dividends paid can be under operating activities or financing, right? So when I pay interest on a note, I could say, gee, I always owe money. I think I'm just going to put the interest I pay under operating. Or you don't pay interest very much and you think, this is really sort of not a normal part of my operations. You may choose to put it under financing. And the same thing, dividends paid, just a choice. Okay, so we start with saying, okay, where do we categorize a cash inflow or a cash outflow? And it has to be one of these. So just with a little bit more detail, here are some examples of operating activities. Getting money from your customers, paying your suppliers, paying your employees, paying for tax, obviously things you do day to day as part of your business. Here are some other examples of investing activities. If you provide a loan to someone, what you do is you give them cash and you have an asset. The asset is a note receivable, right? So that's investing in the debt of someone else. So it's an investing activity. And of course, we talked about investments already, and we talked about the purchase and eventual sale of long-term assets. And then, of course, financing activities. Now, some examples: issuing or paying debt. So if you issue bonds, you've increased your long-term liabilities, but you've certainly increased your cash. So cash inflow from issuing debt, cash outflow if you repay debt. Same idea with shares. In this last section of this introductory video, we're just going to have a brief discussion of the two methods of preparing the cash flow statement. And the first thing to note is that your choice of method does not affect investing and financing activities at all. And if we were to look a little closer at these methods, you actually do or disclose your financing, investing activities using the direct method. For example, if you issue $1 million worth of bonds, then that's financing because you increased your liabilities and received cash. So under financing, you would not say increase in bonds payable $1 million. What you do instead is you say issued bonds $1 million. And that's sort of saying, okay, I issued these, I got $1 million. So essentially, investing and financing are done using the direct method. However, when it comes to operating, we have a choice. We can use the indirect method or the direct method. Now, the fact of the matter is almost all Canadian companies use the indirect method because they just like it better and it seems easier to do. However, both IFRS and ASPE state in their standards that the direct method is preferred. And that's because, we believe it gives better information to readers of our financial statements. So let's just look at what these mean. Everybody knows that we produce an income statement. So let's say here's our income statement and we earned $1 million net income. Because we operate under the accrual basis of accounting, we know that $1 million of income does not mean $1 million extra cash from doing business. For example, one of the biggest non-cash expenses on the income statement is depreciation. Right? So you don't pay anyone cash for depreciation. So most companies should have more cash than net income. Now, the indirect method starts with net income. So with that $1 million net income, we just say, okay, I'm going to start with $1 million. And then I'm going to adjust that for cash. So I'm going to say, well, what part of that $1 million was an accrual and I didn't really get or pay cash? And because we start with net income, everything that we do to get to cash from operating activities is an adjustment to net income. So just really, really briefly, let's say that our net income is $1 million and our accounts receivable went up $50,000 compared to last year. Well, that is $50,000 accrued, because essentially when we sell, we're going to say accounts receivable debit, sales credit. So that big $50,000 increase in accounts receivable means we didn't collect that money. So it's reflected in our net income because, of course, we booked the sale as a credit. We did a debit to cost of goods sold, and we've got some gross profit in there. That gross profit is part of our $1 million net income, but there's $50,000 that we didn't get in cash. So because your accounts receivable went up compared to the beginning of the year, if we're comparing it to that $1 million, we have to take away that $50,000 increase in accounts receivable because it does not represent cash, right? So everything we adjust in the indirect method is to change our accrual-based net income amount from accrual basis of accounting to cash basis of accounting, which is kind of funny if you think about it, because before you took any accounting classes, you probably would have just used cash for income and said, oh, if I get cash, it's income. That's what we're back to. Okay, now the direct method is completely different. So remember, this is just operating activities. When we do the direct method, we start at zero. So we do not start at net income. We don't adjust anything. We just start at zero and we add in items for which we receive cash. We deduct items that are a cash outflow. So in some ways, it's pretty simple. So the next video, we're going to look at some examples.